Hey guys, my name is Colin McLeod from the stockmarketbasics.com. Now recently we've been getting a lot of questions about options, kind of how they work, are they a good investment, and we decided to do a short video series just on the basics of options and how they work. Now ever since investing and trading came online, the popularity of trading stock options has grown with investors. There is more information about options online and the commissions are cheaper than ever. Within this short option trading video series, we'll begin to educate you on the basics you'll need to understand in order to use options properly. Options can be used to make large financial gains with minimal capital, or even protect or reduce risk on your investments. An option contract is basically an agreement between two investors that gives the buyer of the option the right to either buy or sell the underlying asset at a fixed price for a predetermined amount of time. The buyer of the option pays the seller of the option a premium for this right. Think of this almost like putting a deposit on a car, except you can decide to sell that deposit if you want instead of buying the rest of the car. Although there are many different option strategies, a lot we'll go through, option contracts basically come down to four things: buying calls, selling calls, buying puts, or selling puts. There are four different actions investors can take in the world of options, and by putting these together in different sequences and pairings, you can come up with numerous option trading strategies, which we'll cover in later videos. Using call options means that you're betting that the price of a stock or underlying asset will go up, whereas with puts, you're betting that it will go down. Now, buying call options, traders can buy call options if they believe that share prices will go up. This is the same as holding shares in a company or going into a long position. On the other hand, buying puts, traders use put options when they're betting the stock share price will drop. This is the same as holding a short position. On the other side of the table, we've got option writers. Option writers can either sell calls or puts. Selling call options, investors who sell call options are referred to as writers, and use this investment method to either create income through option premiums or hedging their long positions. If you hold shares in a company and sell call options against it, this is known as a covered call. This will enable you to offset losses in the event that the share prices fall. If the share prices go up, you could end up getting less for the shares than you could have selling them on the market. Selling puts has the same idea as selling calls, just in the opposite direction. Put increase in value and the stock price drops. If you sell a put and the stock price goes up, you'll get to keep the premium. If you sell a put and the stock price goes down, you might have to pay the difference. Now, one of the best things and one of the reasons I like option contracts so much is, unlike long or short positions, you always know exactly how much you're risking with every single option trade you make. Now that you understand what options are and how they work, there are some basic words and phrases any option trader must know. First off, we've got the strike price. This is the price at which the option is either worth something or isn't. Exercised. The action of the option holder's right to either buy or sell the underlying asset. Expiration date. The date when the option contract expires. An option needs to be sold or exercised by this date, or else it disappears. And last, we got the premium. This is the fee paid to the writer of the contract for the rights to control the asset by the buyer. Now that we understand all the very basics, let's look at an example. Let's just say on July 1st we came across a stock that was trading for $50 a share, and we strongly felt within the next month share prices were sure to go up at least $5. Instead of buying 100 shares for a total investment of $5,000, we could just buy the August 50 call, which would place our expiration date on the third Friday in August. Let's say the auction premium is $2.50. Times that by 100 shares for a total investment of $250 plus commissions. Always keep in mind that we must multiply the strike price by 100 to determine the total cost of the option contract, as each option contract totals up to 100 shares of stock. At this point, we're excited, and as we just bought control of 100 shares of stock at 5% of what it would have cost to actually enter our position, In order to determine just how much the share price would have to rise for it to be profitable, you add the price per share onto the option premium. In this case, our break-even point would be $50 plus $2.50, equaling $52.50. So for us to actually make money on this trade, the stock price would have to surpass the $52.50 per share mark. If our initial investment idea went as planned, and 2 weeks later the stock price jumped up to $50, we'd be looking at a nice gain of $250 minus commissions, giving us just under 100% gain on our investment. Let's take a deeper look how we came up with our $250 figure. 100 shares at $55 per share equals to $5,500. Minus $5,250 would equal to $250. Now, on the other hand, if our prediction had been wrong and by the third Friday of August, expiration date, the shares were under $50 mark, our initial investment of $250 would be forfeit, leading to a 100% loss. From this option trading example, you can see that options can either offer substantial gains or complete losses. Now that you understand the basic concept of what options are and how they work, our next video will cover why traders use options. Once again, my name is Colin McLeod from thestockmarketbasics.com. Be sure to subscribe to this channel for future updates, as well as checking out our Freedom 35 membership program at the Stock Market Basics.